Today, Jeff, there's something I want to talk about that keeps coming up in conversations, and that is how to decide on the managers you pick as an advisor. And let me just give you a quick backstory, and then I know you have some really good experience with your career path.
Sure.
And have some good advice on this. So, historically, let's say you have an advisor that puts together a group of mutual funds, 20, 30 years ago. They would follow maybe some sort of asset allocation, small cap, large cap, et cetera. As we move into a model environment, advisors are less and less being rep as PM, at least in our conversations, and more towards putting together models of different managers. So now this brings up another issue or a thing that needs to be addressed is how do they put together the models? Now there's pre-built models out there, but you don't know why they were pre-built. Is it because of revenue sharing? Is it because of some other reason? So you and I both agree that one of the things advisors really should get good at or use resources towards is putting together these models. How are you going to go about putting them? Are you going to purely use an analytical? Are you going to dive into the background of the manager? These things need to be addressed. And given what you've done during your career, I think there's no one better to speak on a process to look into how managers manage money, how they run their firm. And so we'll talk about sort of, how you came up with this process, and let's dive through sort of the steps of this process.
Yeah, so there's a couple of things here. I think, and I've talked about this before, I think even maybe on a podcast. I use a phrase called expectational investing. And that's really the basis for what I created, which was my due diligence process. And I think it's important to understand expectational investing is all about, it's not about the returns. It's about understanding what's happening, when it happens, is it meeting my expectations? And so when you think about that from a due diligence perspective, then all of a sudden to understand what each manager says they're going to do, who they are, and the returns to those match up, right? Do they validate or confirm that?
Well,
scenario?
Here's a good example of expectational investing. We had an advisor on the platform, one of the platforms that don't, they never talked to us or reached out, invested in one of our strategies that spends a lot of time in cash. The first, I think, 2 months they were in the program, we were in cash, and then he left.
Yep.
So a perfect example of not knowing the expectations of the strategy and what it does.
Right.
But sorry to interrupt. Go ahead.
No, that's okay, because the next component you mentioned, kind of the BD short list or who's at your conference, that sort of thing. With more and more as platforms become more prevalent, and that ability to easily combine managers, what ends up happening is most of the advisors that I talk to, frankly, their due diligence is narrowed down to choosing a few things on a performance filter, seeing who rises to the top, and say, okay, well then I'll put some money with that manager and see how that works. And while I understand that first and foremost, advisors haven't been taught due diligence. That sounds funny because they go to due diligence meetings all the time, right? But that's salespeople from the sales group that is trying to sell you something, who's telling you how to do it. So what I'm going to do is lay out a little my process, and I don't expect everybody to use my exact process that I call firm CPR. Right? It's the heart of what you're trying to find. But this is some features and functions, some of the pieces of the puzzle that if you can take 2 or 3 snippets out of here and be smarter and wiser about how you're finding your manager or managers, and then you'll have a better understanding of how to fit those together as well. So
any process is better than no process.
Yeah,
right?
absolutely.
I mean, you're just trying to ask questions, and what you've done a great job of is organizing these questions into sections. So let's dive into the first one and go through this.
Absolutely. So I call this firm CPR. It's sort of an acronym for firm structure, communication, program design, and returns. And I always follow that with returns are last for a reason. The first 3, your firm structure, communication, and program design, are really about figuring out who the manager is, this organization. What is it that they're trying to do? What is it that they say they do? And how do they say that they do it? Right? And then the returns follows that with a validation, as I mentioned before, a validation or a confirmation that yes, in fact, the returns match what the expectation has been set. So
Okay,
yeah,
so
let's dig into the firm structure.
the first one is firm structure. What are the couple points that you like to harp on there?
Yeah, I know we're going to keep this fairly light through the process, right? Anybody has more questions can always contact me, and I'll be glad to explain more. But firm structure is really about that very thing. It's who is there one owner? Are there more than one owners? Is it owned by a large? Is this management firm owned by another larger entity? Versus you have the ability to actually maybe communicate with the managers themselves or the owners themselves. What's the distribution look like? Is it a bunch of wholesalers? Are you talking to the owners, or is it all done by platform? Or is this somebody you could go to direct as well? Just understanding some of those structure things about how they're organized and how they distribute. So that's the first piece.
And so I think the big question there, or the big thing you're trying to answer, is who is scratching whose back, and
yeah, absolutely.
And that's important, because decisions that are made based on a small business, a group of employee owned businesses versus something that's an arm of a conglomerate, you have different masters that you're answering to, and that could change your decision making process.
Right. Right. And, again, it's not that one is good or one is bad. It's, do you know?
Yeah.
Right?
It's just about finding
your
out.
Your clients are trusting you to know and understand these things. They assume that you know. So the more you know, the better off you are.
Okay.
And, so we can move on to the next one.
So the next one you have is communication.
Yeah, absolutely. And communication is really, it's how much do we need to define there? But it does make a difference, right? If you're, as an example, if you're doing direct business, right, directly with that manager as a solicitor. Well, look, they're probably going to have some email that are coming out. They're probably going to maybe they have a wholesaler, maybe they don't, right? But there are different, maybe a commentary. How frequently is that generated? Do they do special edition pieces based on market conditions? Some melee happens and they're going to give you some insight, right? How much education, insight, and information are they going to provide to you along the way? I think that's valuable in understanding, again, whether it's working direct solicitor or through a platform, and that may differ even with the same manager. Because, again, the client expects you to know what's going on, and if you don't know what that communication level is, then things happen, and you're scratching your head trying to figure out, well, why did the portfolio do X and the market did Y, and I don't understand, right? And meanwhile, 3 clients are calling you saying, hey, why did my account do this? Well, if you don't know what that communication level is, then you're sort of screwed, and you're having to figure out and make phone calls, but you don't even know who you're supposed to call at that point. So understanding the communication that's coming out, as well as what communication level there is for you, access points there is for you to communicate to them. So
yeah, and it's just, like you said, really figuring out what that expectation is, right? We do a monthly commentary. We've done one since, 10 years now going. We don't do a bunch of webinars. We don't do a bunch of intra-month, flash updates. We try to keep it consistent with the monthly commentary. Some people like that. Some people want to hear about every single trade. You just need to know, as an advisor, how your manager is going to communicate updates, and then educate your clients accordingly, and educate yourself accordingly as to when to expect to hear from them. Right.
Okay. And that serves, and again, it goes in both directions, right? That's us communicating outwardly to advisors, whether they're working through a platform or whether, in some platforms, we don't actually know who is using us. But if we know who it is, right, we're sending these kinds of things out. But likewise, understanding how, there's a question, how do they communicate to us? Right. And we're more than happy in our example, and not every manager's like this, but look, if I get a phone call from somebody who's using us on a platform, I'm more than happy to answer any question for them, right? That's not a problem, but not everybody is that way. Some people treat platform business like, it's arm's length, right? Okay, hey, I'm sending the signals to the platform. They're going to do all the trades. I don't know who you are. I'm not answering questions. I'm only getting paid 20 or 30 basis points or whatever the case may be. And we want to see our advisors, even on platforms, do their due diligence. Call us, understand why we're doing what we do and how we do it, so that you're better educated about the expectation. So,
all right, program design.
Yeah, I mean, look, the list is long but distinguished. I mean, it's everything from understanding trade frequency, kind of to your point with that cash example, right? What securities are being used? Is it ETFs? Is it mutual funds? Is it stocks? All kinds of things. How are we? I mean, are we a quant shop, or I shouldn't say we, but is the manager a quant shop, or are they doing? Are they sending people out to physically meet with these different businesses that they're buying the individual stocks from? Understanding those things, again, goes to that concept, which I mentioned the first three, all about how they do what they do. And that I think that's just critical in, again, setting the expectations so that when you do look at the returns, you get it. And that's your marker. It's not about, up 5, down 5. It's about, should they be up 5?
Well, okay.
Should
Well,
they be down?
hang on a second. So hang on a second.
Yeah.
Let's dive into program design. Like, what are the
Sure.
what are the main points? If you were to start with one thing about the design and go down from there.
Yeah. Who do they say they are? All right. And I'll give you a quick example. So I did due diligence for over a decade. I had a manager out of New York who, I mean, all their website, all their materials, all their stuff was risk manager, risk manager, risk manager, risk manager. All right. Now, in their 10 or 12 years worth of history that they were showing, one year they were up 150%. Well, that's pretty darn amazing, I think you would agree, for a risk manager, right? It kind of begs the question, well, what risk are they measuring if they could be up that much? The following 2 years, in a row, one was down, I believe it was 49%, the other one was like 50 or 51%. I mean, what risk are you managing? So understanding what they say they are first makes a big difference when you do finally see the returns. Because if they didn't say they were a risk manager, you know what? Hey, you're up 150, that's awesome. And then you're down some, okay, you're an aggressive growth manager. That's different from a risk manager.
To jump on that, there was a software, I won't call them out by name, but essentially they automate the design of models. And the point being, on one of the lines, it says there's a risk management algorithm overlay, right? But when you dive into it, all it really means is that when volatility reaches a certain point on measures that they don't tell you, they peel back maybe 5-10% of the portfolio. And so if that's your definition of managing risk, sure. But to your point, how is the program designed? Who are they exactly? And then how are they going about either being aggressive or managing risk? Because that will, have a big sort of determining factor on the expectations. So
right.
what is the second? So besides program design, you said who are they? What's the second major point under that you would try to dive into?
Yeah, very specifically how they do what they do, right? And I'm going to use ourselves as an example, because this one question came up more than any other in 2009 when I had advisors call me. Who uses cash?
Yeah.
Right. And kind of along that line that you were talking about, is it 5 or 10%? Is it whatever? Well, in all of our portfolios, we could go 100% cash. If you didn't know that, it doesn't matter what the returns are. You have no idea what that expectation is. So all of a sudden your clients call you because they've been in cash for 2 months, and you're like, oh, hell, I have no idea what they're doing. What are we paying you for, right? So understanding how they do what they do. All the other things are just sort of subsets of that, right? What securities they use, or are they quant, all that stuff. It's what do they say, who they say they are, and how do they do what they do. Those two things are absolutely the most critical out of that whole program design concept.
Okay. And so lastly, returns. What's your angle here?
Yeah, so the returns are there simply to validate what you have learned. And again, in simple terms, it's, when would you expect, before you even look at the numbers, when would you expect them to do well? When would you expect them to struggle after learning what you have about who they are and how they do what they do? And then all of the returns become relative. And likewise, they're relative, especially if you're looking at combining managers, right? Because what do we all want? We want non-correlation, between the multiple managers we're going to use. We want one to be flying when the growth markets are flying. We want one to be a risk manager to protect our butt when the markets go to hell. Right? And if you don't if you're just looking at returns, that's not necessarily going to tell you the real story. You got to know the rest. So that's the scoop there.
Okay. And so to sort of take this home, I know we talk to advisors all day long, and currently people may or may not have a process. I know people use things like Riskalyze and Advisory World to
Right.
do analytics on how managers perform with each other. But that's only one step. To your example, that's the last step in terms of the return section, because there's a lot of holes in that, right? You're just combining risk scores that may or may not be arbitrary. You need to really understand how they combine with each other.
Absolutely. Combining a conservative risk score and an aggressive risk score does not give you any insight as to what's going to really happen in a different type of environment, right? Is the lower risk score just conservative, or is it a risk-based conservative? Is your aggressive just aggressive, or is it something else? And you got to understand more of those. I don't know Riskalyze, since we're picking on them. They've got some tools to show you how your different portfolios combine, which is good. But again, it's all part of the process. So I think you get the idea, right? The idea here is to take 2 or 3 points away from this and build your own due diligence piece so that you kind of have a checklist of I know my managers because I've done A, B, and C. I call it firm CPR. That's my process. What's yours?
Okay. Okay. All right. What do you got? Any recommendations for this week?
Yeah. So recommendations. This week, it's something that I actually posted on I think it was LinkedIn earlier this week, because I saw that it was actually in response to somebody talking about client education and some of the holes that we have in our society, whether that be if you want to pick on schools or parenting or whatever, I don't care. But my recommendation is Lightbulb Press. They have produced for many, many years, it's a publication company, they've produced some very small booklets. They're about half width, so it's, I think, 4 by 11 or whatever. Some really nice booklets that are about half cartoons, right? They're illustrations, would be a better phrase, and small bits and bytes. And then they have really good indexes. So if you want to know more, and I would recommend that you share these with clients and prospects, because sometimes you'll have somebody who wants to know more, and you can talk to them all day long, but to give them a tool where it's easy to read a small snippet, or they can look in their index and find something on personal finance, on estates, on trust me, you can just go out and look. We'll provide it in show notes. You can go out and look at all the different guides and booklets that they have. Usually they're $6 to $10 a piece, but I do highly recommend them because I've gotten great feedback and I've shared them with a lot of people. So
okay. Yeah, for me this week, it's something you helped me figure out a 529 plan for Nebraska, TD Ameritrade Nebraska.
Yeah.
And one of the cool things they have is, so they partnered with a company called Ugift. They either partnered or own them, I'm not sure. But essentially you go into each child and there's a gift code. And you can add certain people, like grandparents, for example, to that gift code, and they get an email where they can easily set up an ACH or through credit card and deposit into the 529. And it just makes it so easy, because the grandparents have been asking, like, how can I do this? Can I set one up? And this sort of just allows you to 2 clicks start depositing money and paying for your grandchildren to go to school, so I don't have to.
Your video that you posted on Twitter and LinkedIn, you're basically the GoFundMe iteration, which is you're right. I mean, I think you're absolutely right. What a 529 really is. It's pretty freaking funny, man. Your kids are great. So if anybody is listening or watching and they haven't connected with you on any one of those 2 social media outlets, I highly recommend it, because your kids crack me up, man. All right. On that note,
I use them as pawns.
Yeah, there you go. Well, it's cheap labor. Work for me, or I won't feed you.
No, they're not fucking cheap, but just labor.
Oh, man. All right. Yeah, let's end this. All right. So subscribe. If you have anything you want to comment, just go to our www.potomacfund.com, click the Connect Us page, and we'll look forward to seeing you next time. Thanks.
See ya.